right, everyone. It is 6:01. Thanks for joining us on this Thursday evening. It's actually a beautiful night out, so we really appreciate you taking the time to join us. I'm Sheri Shannon.
I am Liz Welch.
And we are going to talk to you guys all about some credit tonight. Still going to be letting some attendees in as we just start talking all things credit.
That's right. What is credit, Sheri?
Well, credit is a contract between a borrower and a lender, but it's a little bit more than that. And but it is something of value. It's something that you have to pay back.
Yep.
Right.
Yep.
And yeah, generally with interest. We do see some buy now. 0% interest offers once in a while, and those are considered credit as well. So still, sorry, I'm still signing in some people, so I'm a little off my game a little bit. All right, moving right along.
5 C's of credit. First one is character. This is the biggest one, I believe. The character is really you as a person. It's your trustworthiness of how much you're going to pay them back. So a lender is going to look at your credit and look how much you've missed in the past, look at what your score is. This is really that first step in getting to know them. I will say you don't really get to talk to a person when you're applying for these most of the time. So this report and your character is really how you tell your story of who you are.
Yeah, it's really important because we are in this day and age. There's so many ways to apply for credit. And so we're doing it online. We may never meet with our lender face to face. So if you don't have that opportunity to meet with a lender face to face, kind of tell your story about what happened in your life, to explain where your credit is today. Your credit report is really that lens into your character for a lender.
That's right. The next one is capacity. So just how much you are going to repay these loans.
So we're looking at your income and how much other debt you already have to determine if you're a good risk to lend money to. So if you have other debt you're paying on, we want to ensure that we're not going to hurt you by lending you more money.
Another thing with that capacity is they're also going to look at your work history.
So that's really important. Yes.
You know, if you are moving from job to job on a normal basis, they're going to see that. And it may be a story of not being trustworthy enough to have that income. So it's really making sure that we are looking at that whole picture.
Right.
That whole picture of what you are doing to get your income.
So moving along to capital. Capital is the third C of credit. And this includes what do you already have? So savings, investments, assets that you're willing to put toward your loan. For example, if you're going to buy a home, more than likely you're going to need a down payment. And so how much capital do you have available to put down for that home? Or maybe you're going to buy a new car and you really don't want to pay full price, or you don't want to have that full amount of that loan for a new auto. So you're going to put some money down on it. That's what your capital is.
And then you have collateral. And these are things that you can put up towards your loan to protect that. So lenders will see you have a home or you have an auto car, and you're going to put that towards the loan to make sure that they are protected. So if you are going to default on that loan, your collateral is how it's going to be paid off. So things like your home, your car, a boat, those types of things are your collateral.
Exactly. And so sometimes when you're applying for personal credit, so something that's what we call unsecured loans, we're basically using your signature as the guarantee that you're going to pay this loan back. So this is why sometimes lenders are a little bit stickier about lending money for personal loans, is because they want to ensure that they're going to get their money. So they may ask you if they don't feel like your character is as strong as they'd like, they may ask you to put up some type of collateral. Sometimes it could even be a savings account. So if you have money in a savings account, they could, there's things called share secured loans. So that's another piece of collateral that can be used.
And last C is conditions. And this is going to be how your interest rates and your terms are kind of determined. And they look at all different factors. They're going to look at things like inflation and the rates of your employment, all the different things around us, the environment, kind of the conditions, what's going on.
Exactly. And it's important to understand these 5 C's of credit because they will really be looked at holistically when you are applying for new credit.
That's right. All right, credit score. My favorite thing.
Yes.
Credit score, I like to call as your adult GPA. This is really going to be what gives you those great opportunities. The higher that score is, the better opportunities you're going to have, whether it's getting a loan or a credit card, getting approved automatically, things like your car or your cell phone and your car insurance, those types of rates can all be determined by a credit score. Well, a few more people coming in.
We have just a few joining us. I'm going to take a minute since we've got some that have just joined to just say that if you have questions, feel free to put them in the chat. We are manning the chat and we're happy to take those questions. Or as always, we love it when you open up your mics and talk to us. This is a very interactive time. And so Liz and I, while we want to get all this great information out to you, we also want to hear from you. What are some stories you have? What are some questions you have? So feel free to pop those in the chat or open up your mics at any time.
All right, so we are going to move on to a couple different scoring models. Yeah, first one up is FICO.
FICO scoring model, this one is one that you're probably very familiar with. It's been around for a long time. Liz
I like it, the old school.
Old school scoring model, but it is the one that most lenders defer to when you're applying for credit with them. And so this scoring model has 5 basic steps. The biggest piece of this pie, I like to call it, is your payment history. So this is why we stress, and I think you will hear this from Liz and I a lot, anytime we are having a webinar, we're talking, depending on what topic we're talking about, we're going to talk about making your payments on time every time.
Yep.
Even if you're only making minimums. I know sometimes when we have credit cards and we really want to get those paid down, and so we try to think about paying extra all the time. But if that paying extra means that you might not be able to pay something else on time, pay your minimum on that credit card and pay your other payments as well, making sure that all of your debt is getting paid on time, because that payment history is super important.
Yeah, I like to talk about too, all the bad things that can happen on your credit seem to last forever.
Oh yeah.
I mean, 7-10 years.
Mm-hmm.
All that good stuff that you do, if you take it away, I mean, they will take it off immediately.
Mm-hmm.
So as we're talking about this, we're going to talk about the length of your credit history. And that's one where immediately, if you close those accounts, they'll take that goodness away. So it's not the best, but learning how this game of credit scores are, you can play that game and know a little bit more. So your payment history is really that character that we were talking about.
Exactly.
And wanting to make sure that your payment history, this is the main part that they're going to look at. So set up those auto payments, making sure they're always paid on time, because that's going to last for 7 years. Just one missed payment can knock you down for 7 years.
That's a long time.
Long time.
That stays on your credit report for a very long time. So the next is the next big piece of the pie is the amount of money you owe on all of your accounts. So whether it's a revolving credit account or if it's a installment loan, this is how much you own compared to what you've borrowed. So you want to keep those amounts owed pretty small. For instance, on revolving credit, you don't want to use more than 30% of the available amount you have.
That's right.
Over 30% can really start bringing your score down. So rule of thumb, to make credit work for you, use your credit cards, pay them off at the end of the month so that you don't have to worry about how much utilization you have. But it's not always easy. We get it. So just be diligent in how much of that credit card, that revolving credit you're using. Then go ahead.
Yep. The next one up is new credit. So this is another thing that's going to live out there. So it's every time you are applying for a credit card, a loan, these hard pulls on your credit, they last for 2 years.
Yes.
Again, another thing that lasts for a long time on that credit report for you. So making sure that we know when we're applying for credit that we can be approved. We are not out there applying constantly over and over, because that's where it's going to hurt us. When those lenders see that there is this long list of applications out there of different credit that you've applied for and been denied for, that's where it's going to hurt you.
Yeah, those are red flags for lenders. But here's a couple of things to consider. All of those hits will hurt you. There are times when you can have several hits within a 30-day period that they're only going to be looked at as one. And one is autos. When you're car shopping, your credit's pulled if every time you're talking to someone about purchasing a car, they're going to pull your credit. So the scoring model gods, whoever
the bureaus,
they got together and they determined that if someone is doing that within a 30-day period, they're only going to count that as one. So that all of those, say you have 5 or 6 out there, they're only going to count as one for you. The other is mortgages, is the same thing. Maybe you're shopping for good mortgage rates and you're trying to find a good lender. If you're doing that within a certain period of time, it's only going to count as one hit against you on your credit score. But remember, all of those inquiries do stay on your credit report for 2 years. It might only be 10%, but if you're doing a lot of inquiries, that's a lot against your credit score.
Yep. So length of credit history, we talked a little bit about this earlier, but that length of credit history, again, 15%, not a huge chunk of the pie. However, it is very crucial to your story. So it's how long you've had credit. So if you've had a credit card, say since you were 18 years old, and you finally pay that off and you're so excited and you're going to close it so that you no longer use it, well, guess what? All that history showing that you had credit and you were paying on that credit for that long is now gone. Again, immediately they take that good stuff off. So keep those credit cards open.
So, and here's something else. You don't have to use them all the time to keep them open, but you want to use them periodically, especially your retail, your department stores, Lowe's, Menards. If you've got a credit card with them, you've paid it off, use it once in a while, pay it off when the bill comes in, because eventually those stores will close those cards. And so then you lose all that great credit history again. So again, it's not bad to have credit cards. It's just how we use them can be bad for us.
And this last piece of the pie, and this is your credit mix. So this is revolving and installment loans. There's 2 different types. The revolving is going to be those lines of credit, your credit cards, the things that you pay off and you get it back again. And it's revolving. But then you have your installment loans. These are going to be like your personal loans, your house loan, your car loan. They have an end date. So lenders are really wanting to look at both a revolving and an installment loan. They want to make sure that you are able to do both. You are able to pay off in a timely manner those installment loans, but also you're able to use those revolving loans and credit cards responsibly.
Absolutely. Good point. So all of that together creates this FICO scoring model. All of these pieces go into creating your credit score. Really important stuff to consider. Now we're going to look at this other scoring model. This is the Vantage scoring model. This is what Liz calls
the new school.
The new school. Yeah. So It's the cool kids
It's
on
the
the
cool
block,
kids on the
right?
block, right? This is your Credit Karma,
Yes.
your Savvy Money. These are the Vantage scoring model, and it is broken up into 6 different categories as opposed to 5 different categories, which is why you get that different score.
Yeah, once in a while you might notice that if you're looking at your credit score regularly on Credit Karma, Savvy Money, in your digital banking, a lot of digital banking apps will use a Vantage scoring model for their customers or members. And so you want to understand that this is why sometimes those scores might look different. Say you've been checking your credit and you know your score is this, but then you apply for credit and your score may come out as something different. And this could be why. If your lender is using FICO scoring model and you've been checking everything on Vantage, and it's not always that one is higher than the other. It could be the opposite. It just really it's really all up to how you're utilizing credit and how it is measured out. So both really valid scoring models. Just looked at things just a little bit different.
Yeah, the couple differences is your payment history and that Vantage, it's even bigger. So, you know, it was 35% in the FICO, but in the Vantage, we're all the way up to 41%. So payment history, and we said we were gonna instill this in you. Payment history is such a huge part of understanding credit, and it's making those payments on time. It is your character. So making sure that we pay those bills on time, kind of continue going, is really how you can help set yourselves up for greatness on both the Vantage and the FICO, because it's such a huge chunk of those scoring models.
Other one that's new on here is balance. And so this is the total balance of all that you owe. So where we talked about on the FICO scoring model, we have utilization, right? Well, Vantage has said, you know, utilization is important. We want to make sure you're utilizing less than at least 30% of your available credit. But Vantage is going to give you, they're going to break it out so that they're also looking at the total balance of all your credit accounts. So that's another piece that's different. Anything else on Vantage scoring? So really, you know, both scoring models, again, really good, valid, important to always check your score. And either one is great.
And I will say, before we take some questions here, when we email this out, we will email out the recording to you. I'm also going to email out these slides. So there's a lot of information on these slides, and it was designed that way so that when you guys get them in like a PDF form, you can really read that information. That's why we're not just reading it straight off to you. Just wanted to let you know I know there's a lot on there. We'll get that in your hands.
Yes. So we want you to always have this information available to you, which is why Liz creates such a fabulous slide deck for you to take home. So any questions on the things that we've talked about so far? All right. Well, feel free to type in at any time or open up your mics. We're going to keep moving. We're making good time. Oh, wait. What kind of credit is student loans? Student loans are considered installment credit because they have an end date that you can't, once you have a student loan, while you're paying on it, you can't borrow against it. Whereas revolving, like a credit card, you can continue to use it as you pay it down. So every time you make a payment on your credit card, it frees up more money. Your student loan is different. So it's considered an installment loan.
Yep.
Great question. All right. So let's talk about credit reports, Liz.
Yep. Let's start with, we need to check them regularly.
How do we do that?
Annualcreditreport.com. Again, I'm going to send you this slide deck and it's got it in here, but also make note of it, annualcreditreport.com. For free, weekly, you can check your report. So it's not going to give you your score, but it's going to give you your report. And the main reason we want to look at that is because we all know fraud is real. And the worst thing that can happen is you go to apply for that dream house. You have no idea that someone has taken credit out in your name and you're denied because now you have a bad score because fraud has happened to you. And we've seen that. That's happened.
Yes.
So going out and checking regularly, making sure your name, your phone numbers, your address, your birthday, your employer and past employers is all correct. But also making sure that no credit has been requested that you did not do.
Exactly. And that's really, you want to make sure that every credit line on your credit report, it belongs to you. It's something that you have applied for. What else you can do with at annualcreditreport.com is you can pull your credit from all three credit bureaus. So TransUnion, Experian, and Equifax. I want to say Expedia, but that's not a credit bureau. And you want to check from all three, and you can pull from all three on a weekly basis for free. Again, checking for all that valid information. Why do we want to check all three credit bureaus? Well, here's why. Because not all lending institutions report to all the same bureaus. So just because you pull TransUnion and it has all the things and you're good with it, Experian, I almost did it again, Experian and Equifax may have other reporting on them. So you pulling from all three ensures that you're checking your credit closely across the board. We have a question.
So what about past divorce? How long does it take to separate credit?
Well, that's a great question.
Yeah.
And that's a question I can't answer, but we can find an answer for you and get back to you for sure.
Cheryl, I will have this saved and I will do my research and I will ask some of our experts here. And then I will send you an email because I have that email from your registration and we will be in contact.
Yes. Thanks for that question. It was a really great question, Cheryl. And we like learning.
We do like learning.
So thank you for that.
Another great thing you can look at, not everybody knows when something's gone into collections.
Exactly.
So going out and checking this report, you can see if something's gone into collections. It could be from a while ago, but it's still going to be out there showing. So now you can take the steps to figure out how you can rectify that situation. But also things that can be on there that you can dispute could be you've paid off of collections and they have not reported it to the bureaus yet. So making sure that we're checking to make sure, hey, I paid that off. It should no longer be on my report. You can dispute all of that from annualcreditreport.com. They'll walk you through those steps.
Well, and sometimes when you do pay off a collection item, it could still stay out on your credit report, but it should be saying that it was paid by you. And that's really important because lenders will see that. And if you're applying for credit and your score is X number and but the lender's going through your report and they say, oh yeah, life happened. But they rectified when they had the opportunity. They can see that. So even if a lender won't remove a collection item once you've paid it, it's still good to have paid it so that that next lender sees that you did that.
Yep.
It's really, really important to be able to show them that you did that. Because again, that goes back to your character.
Character is just the biggest piece.
Yeah, it's the big C.
It is the big C.
Yep,
it is. Your report is that story of your character. Yeah, it really is what it is.
On annualcreditreport.com, I can't plug this website enough because there's a lot of greatness out there. So one of the things that you can do out there as well is dispute inaccuracies. And annualcreditreport.com will show you how to do that. Something else you can do if you're worried about your credit and you're worried about fraud, you can put a freeze on your credit. And this eliminates anyone from being able to apply for credit in your name. The beauty of this is it's free and you yourself can lift that freeze temporarily anytime you want to apply for credit. So if you're worried about fraud, you want to protect your credit, check your credit, all the things, annualcreditreport.com is the best place to go.
It's a great tool. And it's free.
It's free. We love free.
So we've talked about a lot of this in the previous slide about why we should be checking our credit report. So again, those identity errors. I would suggest, have you contacted the lender, the creditor? Contacting them and figuring out a solution is going to be the best option. Keeping those lines of communication open is really the best things that you can do. So if you have an issue with what they are saying you owe, I would give them a call. You have multiple times.
Okay. So, if you've disputed it, I guess my question is, have you disputed it with the lender or have you disputed it with the credit bureaus?
Both.
Okay. So here's what we know, and this is, I would go to annualcreditreport.com, because what we know is that if a credit bureau cannot prove that that belongs to you, they have to remove it. And there's information on annualcreditreport.com about that. So check that out. And then if you still can't find the answers, feel free to reach out to
Yep.
either one of us. We're happy to dig deeper for you.
And our email will be at the end of this slide deck for you as well. So you'll have that when we send out that email for you as well.
For sure. Happy to help.
So those identity errors, checking for them. And I mean, is your name spelled right? Is the year of your birth correct? All of those things. We're making sure that our personal information is correct.
Your social security number.
Yeah.
It could be one number off. And you would be amazed at how many times somebody can pull up a credit report with just their name and address, and then without their social security number. So you want to be making sure that all those things are correct. What are some things that you can do to improve your credit? So one of the things that you can, when you're looking at your credit report, you can see areas that you can help improve your credit. Maybe it is paying off that collection item that can help boost your score. Maybe it's, oh, wow, I didn't realize I was using that much of my revolving credit. So what do I need to do to pay that down? So it's just really getting a good deep dive into your credit history.
You can really see that whole picture when you're looking at your report.
Absolutely. Anything else you want to cover on here?
I don't think so.
Okay. We're moving on.
We
are moving on.
Again, we've talked a lot about this, but here's some ways just to improve that score. So we check in our credit report. We're doing that often, but we're paying our bills on time.
Yes, pay bills on time. We're gonna beat that into your heads. We're gonna keep saying it all the time.
Reducing the amount that you owe in your debt. So we are making sure that we are under that 30%. We are making sure we're paying off as much as that we can. A great tool that I did not create a slide for, and I should have, to help you reduce that is called a snowball. A debt snowball, or I like to call it a snowball effect. I don't know why.
We like snowball effect.
Snowball effect. Yeah. This is a great tool to help you pay off those high interest credit cards or debt in general quicker than you think you can. Even if all you have is an extra $10 a month to put towards this, the light at the end of the tunnel is crazy how quick it can go.
It really can. Sometimes we think we have to dump a bunch of, like you say you've got 3 credit cards and you are trying to pay them off as fast as possible. So you're paying maybe $5, $10 extra every month above the minimum. It can seem like that's just going to take you forever to do. But with the debt snowball, you're starting out with your smallest amount. And you're going to say, okay, I'm going to put 10 extra dollars towards my minimum payment on this one. I'm going to pay minimums on the rest. And I'm going to focus on this one until it's paid off. And then you're going to take all that money from that one and you're going to roll it into the next one. You see that? Roll like you're building a snowball. And then you're going to do that until all your credit cards are paid off. And you would be amazed at how fast you can pay off your debt with the snowball effect.
The snowball effect. Sheri and I really do love to create these. If you are looking for a tool and you need some help, please reach out to us. Our email again will be at the end. We would love to help with that snowball effect. I also can send you some visual aids to help you kind of understand how it works. Just send me an email.
Absolutely. Another way to help improve your credit score is don't close those accounts. If you pay something off, leave it open. Keep that good credit history, because the minute you close it, you lose all of that and it is going to drop your score. And then credit mix. Liz talked about that a few minutes ago, having that revolving and installment credit.
That's right.
Okay.
So it's not just about loans and credit cards. What else can a good credit do for you?
It can do a lot of things for us. I mean, it can help us with easier credit approval. So if you're applying for credit and you're finding it hard to get because your score is low, working to improve your score is going to help you the next time you apply for credit. It does help you with easier credit approval. More housing options.
Yep.
Believe it or not, landlords look at your credit. Now they're going to do just what we call a soft inquiry. They just want to see what kind of risk you are. So if you pay your bills on time, they're going to see that. Even if your score isn't quite as high as you'd like it to be, but if you're paying your bills on time, they can see that. They're going to say you're a good risk for them. Job opportunities.
I was going to say employers, they also can look at your credit report and see how trustworthy you are. Absolutely. That is, again, it's your story on a piece of paper. It is your adult GPA, but also things like your insurance rates. You can get better rates with a better credit score.
Yes.
Cell phone companies, they also take a look at your credit to see how much of a risk you are. There's lots of things that your good credit can do for you.
Higher credit limits.
Yep.
You have the option to get higher credit limits. Now, here's the thing about higher credit limits. It's nice having that higher credit limit, because here's what a higher credit limit can do for you. It can boost your score. And this is why. Because when your credit limit is higher than what you're using, what do we have?
Yeah, we're at that 30%.
We're at that, that 30% of your score. So, but you can only get those higher credit limits when your score is high. So remembering that, aspiring to have that excellent credit score can really open a lot of doors for you.
Absolutely. All right, so we've talked a lot about credit cards, and definitely don't want to make it to the point where a credit card is bad and, not wanting to max them out. Sometimes we can't pay them all, but credit cards can be a great tool also to help you. They can help you build your credit.
Yes, they can.
Absolutely.
Yes, they can.
We've talked a lot about the different ways a credit card builds that. But also they can work for you in a way of cash back and rewards.
Exactly. So by having a credit card with rewards or cash back, you're paying yourself, or you can think of your lender as paying you. The way to do this, you use your credit card, you pay it off at the end of the month. And when you use it, you're earning rewards based on how much you use your credit card for, or cash back percentages, some as high as 5% on certain things that you're using for that credit card for. And so as long as you're paying it off at the end of the month, you're doing that interest free.
Yep.
And you're making money, or you're gaining rewards. So,
or airplane miles,
or it could be anything. Discounts on furnishings, or gas, groceries. So there's a lot of great ways that credit card usage can be a benefit to you.
It is good in an emergency.
Oh yeah.
There's a lot of us that don't have an emergency fund. So something happens, it may be nice to have that credit card. You can take care of the situation that you're in.
Absolutely. Absolutely. Is a great way to have quick cash in an emergency.
Yep.
And it will help you build your credit as long as you're using it wisely. Using less than 30% of your available balance, paying your balances on time, or at least making your minimum payments on time, and just using it wisely.
That's right. All right, any questions?
We want to take all your questions, because we have shared with you all the things about credit that we're going to share tonight, but we'd love to hear your questions, comments. Have you had a good experience with credit or a bad experience? We'll take those too because we've all had them. And but if you don't want to share tonight, feel free to always reach out to Liz and I. We are happy to work with you.
Absolutely. And these couple of questions that we do have in the comments, we are going to take a look at those.
Yes.
Get back with you guys on
will
those.
Definitely follow up on those. But you can reach out to us at partnership@uoficreditunion.org. And if you want more resources on financial wellness, go out to our financial wellness page at uoficreditunion.org and access a ton of resources and a free financial wellness assessment that will help you better understand your financial needs. Oh, we have a question.
Past due medical debt.
It is weighted the same. It's still a derogatory item, especially when you're looking to purchase a home. Most of your mortgage lenders are going to want a clean credit report. So if you have past due medical debt, work on getting that cleaned up before you start looking for a home.
And we talked earlier about that communication line. So it's calling and it's making that, talking with the medical places.
Yeah.
And getting those payments set up as, even if it's a plan over so long to get that paid off.
Yeah, absolutely.
As again, a lender's going to see that you are working with them to get that paid off. And that'll be a good mark on you.
Absolutely. Absolutely. Great question.
Well, that is all that we have.
Thank you guys very much for joining us on this beautiful Thursday evening. And we will look forward to hopefully seeing you in November when we're going to talk about
all the things you wish you knew.
Yes. So look for that on our financial wellness page. Have a great evening, everyone.